Next up we have a guest.
And we are live. And Sonu, as we're doing this, we're live on LinkedIn. We're live on YouTube. We're live on, what's the other one? X. It looks like they're working everywhere. Hopefully everyone hears us. And yeah, I was on mute there. Now I'm off mute. So we made it. Sonu, I was going to make a joke. We might not need to do this because apparently the tariffs aren't a big deal anymore, but they are.
The trade war is over. The shortest trade war. But
shortest trade war ever.
And I got something to celebrate, by the way, which you will appreciate.
Yep.
I got a milkshake.
So people who watch us, we do get what chocolate. I mean, I was going to ask
chocolate. Of course, I'm going to get chocolate.
Chocolate, double chocolate, triple chocolate. That's the real question. But we're really excited to put together this special live stream event. I don't know. A week ago this time, we thought we might be talking about AI right now. Right, that was the big worry this time last week. And then we fast forward, Sonu, to the tariffs, and believe me, things are changing. I believe the word we use is it's fluid out there, but we're really excited. Again, this is facts versus feelings. Talking tariffs, Ryan and Sonu here. Plan is we'll go 40, 45 minutes or so. We're going to talk about the latest with tariffs and how it matters to the market, how it matters to policy, and how we, the Carson Investor Research Team, are managing our models, what we're doing with the increasing uncertainty that we're seeing out there. And I just want to take a moment, Carson Group, we have over 500 advisors in 42 states all around the United States. It's so much fun to be their research team to help them. Sonu, you and I have done multiple calls. Our team has multiple calls, put together many things. I know a lot of our partners are joining us right now listening. But it's a lot of fun. It's something we like to have a good time, but we don't take it lightly. The job that we have of managing money and also communicating what is going on out there. When you come in a day like yesterday morning with futures down a ton, this is Monday morning, emotions are high. We wanted to put together this special live stream. So Sonu, we'll get into the weeds of it first, but what do you hope to take away from this over the next 40, 45 minutes?
Gavin, let's start with something you said. I know we're going to talk about our own models and how we think about the portfolios, but maybe we start there, right? We start with the 2025 outlook. We came into this year saying we are still positive on equities. We don't think there'll be a recession. That's what we said, last year this time. That's what we said 2 years ago this time. And nothing's changed, right? And maybe, everyone else thinking there wouldn't be a recession has probably changed. But look, within our outlook, we talked about the tariff threat. We talked about the risk of the Fed keeping rates elevated for higher for longer. We do expect rate cuts. We'll talk about that, especially within the context of the uncertainty this tariff situation is creating. I think that's really what matters more than anything else, as opposed to anyone's prediction of no inflation or yes, there'll be inflation, things like that, right? But yeah, no, we talked about all this stuff, but we think the opportunities, whether it's market momentum, whether it's labor market strength generally, whether it's productivity growth, whether it's household balance sheets, and potentially opportunities on the fiscal side with tax cuts and deregulation, we think that's more than enough to carry, or outweigh the threats from tariffs and all this other stuff.
No, absolutely. S&P gained over 20% 2 years in a row, as everyone on this call probably knows. Will we gain 20% this year? We're not going to complain if we do, but we're saying between 12 and 15%. We actually think bonds are going to have one of their better years, between 4 to 7%, one of the better years they've had in a while. Rates have stayed stubbornly high. But again, as this economic cycle ages, there are some changes. There are some increased worries. We're not just all in equities like we were a year ago or 2 years ago. We'll get into the weeds of this, but we've done some changes to the models as uncertainty is increasing. But so that's I think it's a good start, right? And again, 2 years ago when we came out with our outlook saying there'd be no recession and stocks would do really well, it was very, very hated. Last year, still kind of got some funny eyes. Now I look around and, I think people are realizing things are pretty good. Now, when things are pretty good, that can set a high bar. Then you have moments like last Monday and this past Monday, the past 2 Mondays, I guess I'm trying to say, you can have some volatility. But again, let's remember this, right? Your average year sees 7 separate 3% mild pullbacks. It sees 5% peak to, or 3.5, 5% pullbacks. It sees 10% correction on average, and you see a bear market about every 3 or 4 years. So volatility is the toll we pay to invest. We like to say that around Carson Group, Carson Investor Research. To think this year, 2025, was going to be the 1 year, Sonu, where everything went straight up and there was never a bad day and there was never a scary headline, probably wasn't very wise. And here we are with the AI worries and with new president, potential worries there, and now the tariffs and the potential trade war. There are worries, but every year, even the very best years, tend to have scary headlines. I think it's so important to remember that. Well,
actually, on that, while we'll get to the tariff thing. That's enough to talk about.
We're trying to avoid it.
We're trying to keep pushing it away. But let's talk about February real quick. You've done some good work on February, especially presidential election years, just to set that as a historical backdrop, right? The cause of volatility, all that, it's always different, but some things repeat. History rhymes.
Yeah, I mean, we talked about this last August. I think we did a special podcast. I'm sorry, not podcast, special live stream last August around that volatility and around the yen carry trade unwind volatility. And we actually pointed out and talked about it then, for whatever reason, August seems to have more of these out of the blue events than any other month. Lots of volatility. Well, fast forward to what Sonu just said. February of a post-election year, where we are right now, out of the 12 months, is the worst month. It's up 1.3% on average, so not that great. I mean, not all that great. Actually, sorry, it's down 1.3%. Apologies, down 1.3% on average, and up like just a coin flip. Okay, so that is the worst month. Now, if you look at the last 10 years, 20 years since 1950, Sonu, once again, February is one of the worst months. Usually it's September, but February, September, and you got to ask yourself, well, why? It's one of those things I always say I'd rather know than not know. You think about a post-election year. You had the election. Maybe people feeling good November, December, January. And as you said, the honeymoon ends in February. But I guess my question for you, Sonu, what we're dealing with right now, new president coming in with some potentially unpopular policies that he ran on, yes, but still unpopular. Maybe just new presidents tend to come in and by February, they just get some bad stuff out of the way to get it out of the way. Or it's as simple as, hey, the best 3 months of the year just ended, so you can't go up every month. Oh, by the way, for all the financial advisors,
that would be nice.
When you talk to your clients, just point this out. The S&P has been up 8 of the last 9 quarters. All right. 8 of the last 9 quarters. I mean, one of these days we're going to have a down quarter. It could be this one, everybody. I mean, who knows? We're still in a structural bull market, but let's just remember where we've been. But Sonu, why do you think February tends to be that banana peel type of month, I guess is what we'll call it?
Especially, let's take accounting for election years, right? Or
yes.
Post-election years, right? The first year of a presidency term. I think, like you said, the honeymoon's over. I think our colleague, Barry Gilbert said that. The honeymoon's over.
Friend and colleague.
Now, friend and colleague. How about that? Oh, well, I should say all our colleagues are our friends. And even though all our friends may not be colleagues.
Even people we don't like are our friends. We're just nice around here.
There you go. Yes.
Except for the Chiefs. I don't like the Chiefs, but we'll leave it there. It's okay.
Oh, yeah. Let's not go.
Sorry.
I'm sorry. Not that I care, but Anyway, what was I talking about? We always forget what we're talking
February.
about.
Ask you why
February, right? No, I think the honeymoon period's over. It comes to brass tacks. When it comes to brass tacks, guess who's involved? Congress, right? And Congress is involved. Things don't happen very quickly, right? And I think going back to something we mentioned in our outlook, like we think, yes, the opportunities will outweigh the threats. We have the threat now. The cloud cover of tariffs has come about. And I don't think it's gone away, by the way, just because, we've reached a pause. And it is a pause, right? It's not like, oh, we're never going to impose tariffs on Canada and Mexico. The China tariffs have gone forth. We'll talk about that. But yeah, the opportunity here, like I said, is tax cuts potentially, right? Deregulation. All of that is yet to be seen.
Yeah.
Right. And the market's going to want to see all of that. And I think the market's kind of expecting that too. Remember, at the back of this is also the Fed, right? And how the Fed reacts to this stuff. We'll talk about it. I think forget all the economic impact, inflation impact. I mean, I've read the reports from Goldman expects this, somebody else expects that.
Right.
Which is not to say they're wrong. We just don't know, there's so many dynamics that go into it. Right. First of all, we don't even know what tariffs will be imposed on whom, on what goods, what rates. Right. None of that. And then you get will demand shift? What happens to supply? Right. How do companies react? How do other countries retaliate? None of this stuff is, fixed. Right. So a lot of those inflation, economic impacts is very uncertain. But one thing we know is the Fed doesn't like uncertainty. They've admitted this to us. And I think that's the cloud this tariff thing puts over beyond of course, we think it's uncertain. Markets think maybe it's uncertain, but it's hard to gauge. Markets up today. Everything's green today. What does that mean? Does that mean markets pricing everything's, as if the trade war is over? I don't quite think so. But yesterday, Raphael Bostich, the head of the Atlanta Federal Reserve, said the people he talks to think higher input costs will be transferred 100% downstream to the consumer. And he said, I was uncertain on December 31st. Now there's more uncertainty. Austin Goolsbee, Chicago Fed president, he's been consistently probably amongst the most dovish members of the Federal Reserve, right? And he's been talking about how we need to see rate cuts this year because inflation's going to pull back, and they want to make sure the labor market doesn't weaken any further than necessary, right? But now yesterday he came out and said, this is creating a lot of uncertainty. Susan Collins of the Boston Fed, same thing, right? So I think that's the struggle. If the markets right now pricing in 1 to 2 rate cuts this year, if the market starts to price in 0 rate cuts, I think that's when risk assets will have a problem. I don't know when that happens, if that happens, but that's something to watch.
So I'll jump in. So we'll dive more into the Fed here. That's a really good way to, I think, set the picture here. Let's dive into the tariffs. So you mentioned a lot of what we don't know. Well, let's talk about what we do know.
Okay.
$1.8 trillion worth of trade between the 3 countries, United States, Mexico, Canada. We know that. We also know Mexico exports 83% of everything they export goes to the United States, 77%. Canada exports goes to the United States. U.S. exports about 30% combined to Mexico and Canada. Mexico exported $475 billion U.S. dollars last year. Canada, 418, and the U.S. exported about 700 billion combined to those two. And last one, Sonu, the size of GDP, right? That's your economy. How big is your economy? U.S. economy is about $30 trillion. It's almost there, real close. Mexico, 1.8 trillion, and Canada, 2.3 trillion. So if majority of your exports go to one place, which they do with Mexico and Canada. Sonu, my question to you, is it a shock that yesterday Mexico and Canada, I guess I'm going to say, are playing nicer than China, who said, not so fast. They actually tacked on 10% tariffs on us because they, being Mexico and Canada, are much more impacted by a potential trade war with the United States versus what China might be. You want to build on that?
No, exactly. And we went in with a heavy hammer on both Mexico and Canada, right? 25% tariffs on Canada.
True.
Apart from energy imports, tariffed at 10%, which kind of tells you the White House is worried about price impacts. Otherwise, why tariff energy imports on Canada at 10% instead of 25%, right? But also 25% tariffs on Mexico. China was only 10%, right? Now, the 25% tariffs on Canada and Mexico have been paused for 30 days. But it gets to what you were saying, right? Getting them to the table was not that difficult considering the leverage we have because of what 80% of the Mexican economy is probably dependent on exporting to the United States. It's slightly less, but only slightly for Canada, which is probably why Mexico came to the table first.
Right.
It took one call with the Mexican president, if I'm right, between President Trump and President Sheinbaum of Mexico to reach some sort of compromise. And again, it's temporary, right? Remember, there's no specific goals, objectives, that's been mentioned with respect to security or even trade, right? And that's where, speaking of brass tacks, we talked about that before. That's where rubber will hit the road, right? How do you get to these goals that both parties can agree? And then how do you verify that these goals and objectives are being met? And then
so
Canada...
I'll jump in there because I know where this is going. Yeah. We had some deals with China in 2018, 2019. How'd that go?
Not good at all. I mean, not even close to being good, right? Like China was the phase one trade deal. I don't know if anyone remembers, back in 2018, 2019, we had the trade war. Finally, we started talking. The US signed the phase one deal with China on January 15th, 2020. Just before COVID started. I mean, COVID was already there in China. China was supposed to buy an additional $200 billion of US goods. Most of that was mostly manufacturing goods, right? Think like semiconductor chips, Boeing planes, all sorts of stuff, right? Which is good for US manufacturers. And they fell short of all of their commitments. They barely bought 50% of that stuff, right? Especially manufactured goods. They were, about 40 to 45% short of their legal commitments. I don't know what legal means here even, because obviously there was nothing enforceable. So, and finally, what ended up happening is that U.S. manufacturing exports to China fell in 2018. Right. They fell in 2019. The trade deal was expected to boost these up and then some, but it ended up falling in 2020 and 2021 as well. The trade deal at that time, again, I think we can safely say it didn't work. So I think this time around, I think these negotiations are going to be quite tough. And like I said, it's not just about, you buy this much from me, I'll buy that much from you, or maybe I won't. It's going to be about how do we verify this? What's legally enforceable? How do we punish you if you don't do it? I think that's going to be, that's what we're probably going to spend the next, I don't know, months, maybe a year, 2 years talking about.
Oh, I can't wait. Can't wait. Again, these are third-party takes on things, but Bloomberg says the average tariff in the U.S., if the 25% on both U.S. and Mexico and Canada would have gone in, and China, the average tariff in the U.S. Would have gone to 10.7% from 3%, and U.S. GDP, Sonu, would drop to 1.2%. So it's well above 1.2%. And then J.P. Morgan said the effective tariff rate, if all this stuff were to take place on all goods, would be 2.3%. So obviously a good deal higher there as well. Now, you mentioned
and
China.
That's likely a nominal GDP growth, I imagine, as opposed to real GDP.
Good point.
And nominal GDP growth is right now clocking around 5%, right?
Yeah, good point. So still a decent slowdown potentially if that's right. Now, one thing that you've looked into and we talked about is with getting a little more in the weeds on tariffs. And believe me, we want to talk about portfolios and the Fed and the market too, but a little more on tariffs here. There were ways that you could play a game before, and you can explain this better than I can, but you could break packages up. If it's worth $700 or $800 less, put it in one package and you can play the game. But the U.S. is not playing that game anymore, right?
Yeah. So again, going back to 2018, 2019, like I said, China got around those tariffs in a few different ways. One is they depreciated their currency, so that's going to be interesting to watch. Mainland China markets are closed. When they come back, when the PBOC, the Central Bank of China, comes back tomorrow, where are they going to fix the level of the yuan relative to the dollar, right? So that's going to be one thing to watch. They depreciate their currency. What does that do? It makes their goods cheaper. U.S. exports, more expensive. Literally the opposite of what the U.S. presumably wants, right? In 2018, the Chinese yuan fell by 14%. Right, so that's
was that versus the U.S. dollar or just
versus the U.S. dollar? Yes, versus the U.S. dollar.
That's 14%. a big move for the two largest economies. 14% move. That's a lot.
The second way they got about around tariffs is they shifted factories and shipping to countries around them: Cambodia, Vietnam, Philippines, places like that. Right. In our outlook, we talked about Christmas tree lights. Christmas tree lights. about 85% of Christmas tree lights used to come from China. This was 2018, 2019. From 2020 onwards, guess what? About 90% of Christmas tree lights now come from Cambodia. Right. So, I mean, I don't think Cambodia started a big Christmas tree manufacturing. They had incentives for that or anything like that. So we know what's going on, right? The third gets to what you just brought up, small packages. What did they do to get around tariffs? They have something called de minimis exemptions, right? So for packages less than, I think it's $700, $800, something like that, those aren't tariffed, right? Yeah. So those are not exposed to those tariffs, whether it's 10%, 25%, or whatever it was, right? So what a lot of Chinese companies did, break apart the packages, send in, whether it's consumer goods, but even some industrial goods, they used to break it up, or they still do, and then ship it to the United States. It's below $800, so no tariffs, right? But what the White House did this time, and this is Canada, Mexico, I know those are paused, but even China, they removed that de minimis exemption. So if the tariffs on, say in Canada or on Canada was still in place, if somebody sends a, I don't know, maple syrup basket to Ryan Detrick in Cincinnati, that would be, let's say it's worth $100 or something.
Sounds good. It's worth more than that to me. I like some good old fashioned maple syrup. That sounds wonderful.
that would be taxed at 25%, right? And tariffs are a tax, right? Now, who pays it? The White House says, no, the Canadian producer will pay it. Yeah, well, if somebody's sending you a gift basket, obviously, then that person's going to pay it. But if you, wanted it for yourself, you're paying for it. Yeah, I think chances are you'll pay instead of $100, $125, right? So I think that de minimis exemption is one thing the White House is sort of like, wait a minute, we're not letting you get around this. The other thing that is also, again, they didn't do this time, but remember the second way China got around the tariffs last time around was by just shifting manufacturing, packaging, whatever, to other countries, right? A lot of it actually, Mexico benefited from that too, by the way. What the White House, what the president's advisors have said this time around is that, no, we're not going to let you do that. We're going to put universal tariffs. They haven't so far. They just put Canada, Mexico, and China, the three biggest, trading partners for the US, as you mentioned before. But if they put universal tariffs on everyone, let's say 10% tariffs, like on China, on all the Asian countries, South American countries,
Europe,
Mexico, then you can't get around that, right? There's no point shipping it to, somewhere else and then exporting to the United States. So we'll see more to come. None of this is over.
Yeah. I will say, Sonu, a couple times, I think you got an email. I don't know if your email's open. Maybe close that. Or a ding. I don't know. We always have these dings going around. And that's a great point, because what China did, they set up some factories right on the border in Mexico, and because they came in that way instead. So there's ways around it. The U.S. obviously knows about those, so they're trying to be a little harsher, I guess, with some of these. But the reality, again, I always say, look at the credit markets, because nobody really knows how bad or good, I don't know if good is the right way to put it, but how bad or non-event this tariff stuff could be. But my take has always been that the credit markets are worried. They're the smartest people in the room. Yesterday on Monday, when we came in market getting killed, by the end of the day, junk bonds were barely lower. Today, the time we're doing this, junk bonds are up a pretty good amount. So if junk bonds are hanging in there, that's that kind of canary in the coal mine. So you look at history, when they start to underperform, especially relative to the treasuries, just overall, that's a warning sign. Well, listen, we're not seeing that yet. In August, when we had the yen carry trade unwind, when everybody got really, really worried, rightfully so. I mean, that was a lot of volatility in markets. Once again, junk bonds did okay, right? We didn't see a big sell-off there. So that's some, history doesn't repeat itself. It often rhymes. Mark Twain. We're not seeing that there. So, I mean, do you want to get into markets? Anything else on tariffs, really? We're about halfway done. We want to talk about models, the Fed, and lots of other stuff.
I'm sure we'll probably do more of these, and I'm sure tariffs will come back. Yeah. The only thing I'll mention is, and this relates to the inflation issue. I'm looking at my screen, and right now crude oil is down 40, 50 basis points. The WTI, right, down below $73 a barrel. That gets to a big piece of, if I'm worried about inflation, few places to look. One is, what is wage growth doing in the United States? Is that well above trend? Because that tells you, are there demand side pressures on inflation? Right now, no. Right? Powell talked about that last week. The other is energy. Energy is, that's concerning, right? And that gets to, the point about just 10% tariffs on Canadian energy imports, as opposed to 25%. The White House is aware of this. I got this question the other day saying, hey, Sonu, wait a minute. I thought the U.S. is completely self-sufficient, with respect to oil, right? But the thing is, the US produces something called light sweet crude oil for the most part. But our refineries, US refineries, which refine oil into gasoline, diesel, other products, things like that, chemicals, plastics, whatever, those require heavy crude oil.
Yeah.
That's what it imports from other countries, whether Canada, even some from Mexico. Canada's played an increasing, really big role
Yep.
in those exports. Mexico used to have a larger portion of that, but now it's pretty much almost entirely Canada. Some from Mexico too. By the way, some from Colombia as well. Speaking of
Colombia,
the Colombian tariffs last weekend, right? We had that little drama as well. But yeah, no, I think that's a concern. Like what happens with oil, right? If and that's potentially a way Canada could quote unquote retaliate. Maybe they put an embargo on Canadian oil coming into the US. So at that point, I think we have to raise the probability of Canada becoming the 51st state.
How about that? I mean, so that's we've got these little indicators we can follow, like crude oil, very easy to follow.
Yeah.
Crude oil really starts going higher. That probably tells you the trade war is really heating up and is not good. We can talk about the dollar here in a minute or two. But you mentioned crude oil, light sweet crude, heavy crude. Have you started Landman yet or not yet? You started
Not yet. It's on my list. But see, you confused me the last time because you're like Tulsa King or Landman, right? I pull both up as like, oh, it's Sylvester Stallone, my favorite actor, and like that's what I'm saying.
Landman was real. I personally like Tulsa King more. Maybe a lot of people don't, but Landman was very good, and you learn a little bit more about the oil industry. Now, that's what the whole show is about, right? With Billy Bob Thornton running around smoking cigarettes, just being Billy Bob. But it was pretty good. I know a lot of people like that one.
Right.
So let's see. So another big indicator that we watch every day, I mean every hour maybe, is the U.S. dollar, right? We've said before, if the dollar is strong, Sonu, just real broad swipes here. The dollar is really strong. That's usually a risk-off scenario. The first 10 months of 22, what happened? Stocks down, bonds down, gold did okay-ish, but the dollar soared. March of 2020, everything was crushed. Gold, bonds, stocks, look it up. All three were getting killed. The dollar was strong. If you have the dollar break out above recent highs from, let's say, 3 or 4 weeks ago, that could be another signal that the trade war isn't going, it's going the wrong way, and stress is coming in the system. You want to talk about that U.S. dollar a little bit?
Yeah, I think what drives the dollar, I mean, dollar is a good one to look, including you mentioned like last August, right? When we had that, yen carry trade prices, all of that. Look at that time, the dollar wasn't panicking. The dollar wasn't rising, going higher.
So I'll just chime in just sorry. So the Wednesday of that, okay, back in August, I was on TV, CNBC from New York for 19 minutes. Now, 19 minutes goes really fast on TV, and I didn't talk the whole time, no, but I was on there with Judge and some others, and they're just bearish. And I'm just trying to point out the positives. I pointed out on live TV that Wednesday, after all that stuff, when that stuff was going on, the dollar was down those 3 days. Like, it was a true catastrophe. The dollar would be higher. And I could tell Judge kind of nodded at me like, ooh, that's a good one. That came from you, Sonu. But nonetheless, that's when it really became clear to me. And then we look back in August was 3 days of volatility, and then off to the races. So watch the dollar. Go ahead.
What's the dollar? And what drives the dollar? Ultimately, what drives the dollar is differential economic growth. U.S. is growing well above trend. Europe isn't. China maybe isn't. U.K. isn't. Japan isn't. That by itself should drive the dollar up. Why? Because it starts interest rate differentials as well. Yeah. If the U.S. economy is growing above trend, maybe at trend, it gives less impetus to the Federal Reserve to cut rates. Whereas if you're Canada or Europe, the ECB, Bank of Japan, well, the Japanese is slightly different because they've had low interest rates for a bit, 2.5 decades now, right? But Europe and the Bank of Canada reduced rates from 5% to about 3%. They've gone a long way. And as that interest rate differential between the US and these other countries grow, that puts more upward pressure on the dollar, right? So how could the dollar reverse? Well, maybe if the Fed says we're going to cut more, maybe inflation comes down, maybe there's a growth scare, right? Unemployment rate goes up, then I think the dollar comes down. But right now, look, since the end of September, the dollar is up about 10%, thereabouts. Okay. Right? Maybe slightly less because it's pulled back over the last couple of weeks or so. Yeah. About 10%. That's a big move, right? And some of that happened before the election. It was really, we started seeing really positive economic growth, positive economic data in the US in, late September, mid-October, early November. Payroll started coming in much better than we saw back in summer of last year. So that sent the dollar higher. And then we got the election and the tariff threat. And so the dollar started going up even more then, right? So right now, I think, and that's what's going back to our outlook. We wrote that we weren't that worried. I'm not too worried about the inflationary impact of tariffs, because ultimately, what do tariffs do, right? It raises the price level, which is not to say that's a good thing or anything. I mean, people, we saw from the last election, people don't like higher prices, period, right? Even if inflation may have come down, like, wait a minute, the price level is higher. I'm paying $4 for eggs instead of $2. That's a problem. You need to fix that, right? So I think we were, still I'm in that camp that I don't think the tariffs will be hugely inflationary, but the dollar being elevated is a big piece of that, right? I don't think it cancels everything out, but it is, it mutes that inflationary impacts a bit. But the dollar, rising dollar, strong dollar, I think is a threat. It's not good for U.S. manufacturers, first of all, right? U.S. manufacturing exports in 2018, 2019 was flat. Over the last 2 years, it's been flat as well, while the dollar has been elevated. Just in Q4, right? We just got real GDP data. Real GDP was up 2.3%. Consumption is really strong. Government spending was strong too. But exports goods exports pulled down real GDP growth by 40 basis points.
Yep.
Real exports are down about 5%. That is, the strong dollar and elevated interest rates, which could hit investment and housing, that could be the difference between 3% GDP growth versus 2%. Now, we don't think it's recessionary or anything like that. I don't think it's going to 1% unless we have like a sudden shock. And I don't think these tariffs are, yes, they won't be pleasant, but I don't think that's going to send the US into a recession or anything like that. But it has, a strong dollar has risks.
So let's kind of take that to the next level. We've got about 15 minutes or so here. Looking at the models that we run for our Carson partners, our team manages, we've had a really good run the last couple of years, just simply being overweight equities and U.S. centric, right? Sticking into your home base bias. We've been told a lot of times, oh, emerging markets look good. Oh, developed international is cheap. I've been hearing that for 20 years. I believe they can have some good years. I think 2017 was a good one for other parts of the globe relative to the U.S. But nonetheless, Sonu, we've been in that camp. But, we were more overweight equities, more sticking with, just stocks in general. But now when we look at our portfolios, peel back the onion a little bit and share some of this, we do have some, we say diversify your diversifiers.
Yeah.
We can get into the weeds of this, but we've had a little bit of gold since March of 23. We added a little bit of gold on that violent pullback after the election. Remember the election, dollar up, gold got smashed. I looked at gold like, oh boy, if this is in a bull market, I like to buy things that are pulling back that are scary in bull markets. We did, and gold's literally hitting all-time highs. We've actually added some long-term treasuries sometime middle of last year or so. We didn't touch long-term treasuries. We thought rates would stay higher because the economy's strong. Now, we still like stocks over bonds, right? In a 60-40 portfolio, what are we, about 30% bonds maybe? But we've got some treasuries in there now.
I mean, we are close to, like, again, maybe somewhere between 65 and 70% equities.
Yeah.
And we traded on Friday as well. I think we can say it. We traded on Friday. I mean, we can't tell you the exact trades, but I can give you the directionality of, and even directionality of trades we've done over the last 3 months. I think it all gets into the outlook. We've been in favor of that broadening out story. Yes, last year was tough from that perspective. Small caps, mid caps. I mean, you and I have been talking about that for a while. It's been frustrating, right? But at the end of the day, the fact that we are overweight equities, sort of overcomes a lot of those. Those are not our biggest bet. Right. Our biggest bet is essentially overweight equities over bonds, right? Especially like 60-40 portfolio, we have like 30% in bonds. But we have some gold in there as diversifiers, right? We have some gold. What we recently did about last week really was we diversified those diversifiers even more, and we leaned a little more into that broadening story. We were, more overweight small caps. We shifted some of that into mid caps. And we shifted some of it into, the large cap, not growth. We're not negative on tech. You just think, look, if you have the S&P 500, you have 30-40% in tech anyway.
You've got some exposure.
You need more? We don't think we need more, right? Yeah. So we leaned into the more defensive parts of the market, like low volatility, but even momentum, right? If you look at some of the, I won't put the names out right now, but look at some of the big momentum ETFs. Ironically, it's not tech actually that dominates. A lot of it is financials, right? Financials have had good momentum too. So we leaned into, it's still the broadening out story. It's just that instead of just small caps, you think it's mid caps, small caps, the value side of things, defensives, all of it, right? And defensives is another way to diversify your diversifiers. We've got gold,
Exactly.
we've got managed futures, we've got some low volatility stocks, right? We've got tips in there as well, which we recently added too. So all of this is essentially how we are thinking about, yes, going back to last week, right? The AI story, it didn't make me any less bullish, right? If anything, more so. Think, like I said at the top of this live stream, if anything, it tells you companies are more likely to spend because AI is cheaper. And then, yes, the tariff threat is there, but that's why you want a diversified portfolio as well.
Yeah, so in a way, you could say we're sort of playing with house money because we've had really good run for the last couple of years being overweight equities and sticking with that theme amongst all of the negativity, everyone telling us we were wrong. And now we're just diversifying a little bit, right? And we work with our Carson partners every single day talking about these concepts. Like you said, there's a lot of tech. Last Friday at the close, there's 11 sectors. 10 of them were higher on the year. Technology was down on the year. And that's a very small slice. I get it. Only 1 month. But honestly, Sony, you look at semiconductors, some things, tech has been kind of lagging in some ways the last 3 or 4 months last year. So it doesn't mean we don't like technology.
I think it's down year to date. I mean, granted, it's just been about 4 to 5 weeks, but still.
Yeah. But our favorite group. I mean, we're like a broken record on the Facts versus Feeling podcast. We say we like financials. We say that a lot. Financials, I believe, were the second best performing group last year, only to communication services. But it's having another look at the earnings. Those big mega names, mega cap money center names, banks had some great earnings and some great things to say. So yeah, industrials, financials, small caps, mid caps, some momentum, a little bit of defensive here. Yes, adding some longer term treasuries for the first time in a while, as we think rates, we're going to have maybe another cut or two more than what the market expects versus last year when the market said 6 or 7 cuts. We said, oh no, we're not so sure about that. Probably more like 3 or 4 because the economy's strong. So people have given us a lot of kudos for our overall equity calls. Honest to goodness, I'd put our fixed income calls up there, maybe even better. Nobody talks about them, but I think almost better from that point of view. Anyway, so anything else on portfolios? Without giving away too much, but we wanted to kind of talk about how we are looking at the world from our team's point of view, not just pontificating on a podcast, how we're managing billions of dollars.
No, exactly. Look, at the end of the day, we're still bullish. We've just leaned into that broadening out story, which also works from the point of you don't want to be concentrated in one part of the market. Yes, it worked in 2023, it worked in 2024. I mean, I have no idea whether it'll work or not work this year, but I'd rather have the diversified portfolio, even within equities, than not, right? We did lower some international equities. Again, this goes back to the dollar, right?
Yep.
It's a strong dollar is a headwind for U.S. manufacturing exports. It's also a headwind for S&P 500 earnings. 40% of revenues for the S&P 500 companies come from outside the country, right? Yes, some of it is invoiced in the dollar, but not all of it, right? So that's a potential headwind. And then it's a headwind for international equities because if you're buying a stock in Japan, what do you need to do as a US dollar-based investor? You need to convert, let's say, $100 into yen first, and then buy the stock at the Japanese exchange. That's essentially what's happening, right? I mean, you don't see all the operational details, but that's what's happening. So if the yen goes down, that's a headwind for that position, that equity position, right? Well, irrespective of what the Japanese stock does or European stock, or whatever it is. So we did reduce some international exposure at the margin too. We were already underweight, and slightly more underweight, but so that's where we are. Couple of things I'll mention this as well.
Let me jump in just for a second. Let me just jump in. So we've got about 5 minutes, but I see we have like well over 2,000 people watching in the various places we're sharing this. So thanks for that. And I want to thank Tori, our producer, for helping us put this together. It's easy for Sonu and I to sit in front of this and just talk for 45 minutes. We can do this. You wind us up, we can do this. But there's a lot of work that goes in behind the scenes. So thanks to Tori and the marketing team and communications team and I'm sure compliance has evolved somewhere in there because they always are. So thanks to everyone who's helped us do this very special live stream. So Sonu, again, think of it like this. We've got like 6-7 minutes. So let's go from there.
Looking ahead, what am I looking at? You already mentioned the dollar, obviously. This week, especially the next 2 days, I'm trying to see how nice are the Chinese going to play. China's always kind of played nice. I mean, and then it's really, you have to look like, are they really doing what they...
With food that good, you think they'd have to play nice. I mean, who doesn't love Chinese food?
Yeah, there you go. And so I'm going to be watching what the Central Bank of China does with their currency as well.
Yeah.
Right.
And you mentioned, so China is closed. That's the way to put it. Celebrating Year of the Snake. They open up tomorrow. They're back tomorrow.
Yeah, tomorrow. I guess tonight's technically our time.
Okay,
mainland
so
China, that's when the market.
that'll be interesting to see what their market does, what
Yeah.
happens, because they have been closed for a minute, as they say. I'll just add a couple things, Sonu, that hopefully people appreciate here. When January's up like we were this year, the next 11 months on the S&P is up over 12% on average. But listen to this, up 87% of the time. So when you're up in January, the next 11 months are higher 87% of the time. You don't just go bullish because of that. Well, hopefully we've laid out why we're bullish, but boy, that doesn't really hurt my feelings being a bull. When you're up 2% in January, like we just were, once again, up over 12% on average, and the rest of the year, median's even higher, 13.4, up about 85% of the time. So even a good, strong January doesn't necessarily take away from that. And this is a post-election year, as we've said. Most people on this call probably know the pre-election year, year 3, tends to be the best for stocks, not only the economy, because you try to juice the economy, juice the stock market, get people feeling good for an election year when the election comes. But the last 10 cycles, Sonu, since 1985, the post-election year where we are right now, S&P's been up 9 out of 10, up over 18% on average. That's the best out of the 4-year cycle. Just little, again, bullet pieces, feathers in the cap of the bulls, I'm trying to say, for reasons to think this year could be, again, above average, 12 to 15% returns. And again, I think the reason why post-election years have been strong lately, because midterm years matter a lot more than they once did. Midterm years are a very big deal, so maybe you try to juice things again ahead of a potential midterm year. Let's see, Sonu, so we got 3 or 4 minutes. What else, what are we missing? I mean,
Should
what
we bring back the F word?
Yes, we'd save the F word, and apologies if people, we're going to assume we have a lot of adults out there. We're going to talk about the Fed, Fed. We'll wrap it up with that. Again, the market is saying 2 rate cuts, but you're in the
1 to 2 rate cuts. And I'm still, I have to say, we wrote an outlook. We expect 2 to 3 cuts. I am still in that camp. It's just a matter of how long do we wait?
And it comes down to inflation and I guess tariffs. Because if tariffs really spiral out of control, we're probably not getting rate cuts. I think that's probably safe to say. You got to hope Trump, and everybody kind of knows that too. But if inflation improves like you think, we probably get more cuts. And that's why, again, maybe having a little bit of longer term treasury exposure like we do in our models makes sense, right? You want to build on that?
That's the bet, right? Like inflation's coming down. And that's honestly a bet we've had for the last couple of years, right?
Yeah.
Like,
right. True.
Inflation coming down, so there's less pressure. In 2023, it's about the Fed stopping rate cuts. We expected that. Last year, it was, starting rate cuts. It took a while to get started. They should have probably cut in March, but, Q1 inflation data.
They didn't listen to facts versus feelings. Yeah, had they done that, they would have. Yeah.
And maybe they should have cut in July. They didn't. I know a lot of people talk about like, oh, why are they even cutting, right? Like, GDP growth is 2.9% over the last couple of years. Why are they cutting? Well, look at the housing market. Do you think the housing market's going to function if mortgage rates are 7%? No, right? No. That's a headwind. That's a difference between maybe 2% GDP growth and 3%, right? Along with exports and things like that. The other thing, elevated rates keep, like we talked about, it keeps the dollar on the stronger side. That's not great for manufacturing, exports, and S&P revenues and things like that. No, what I'm watching is, what's the probability of no cuts in 2025? Right now, it's sitting at 12%. Yesterday, it was about 15%, right? Over the last 3 months, if you've tracked, I'll put this up on a blog, after the election, right? So November 5th, all the way through for the next 30 days, through December 6th, the probability of no cuts in 2025 fell from about 10, 15% to below 5%. Right? Markets are like, oh, you know what? We are getting cuts for sure in 2025. Market rallied 5%. Yeah. But then over the next 3-4 weeks, all the way through January 10th, right? The probability of no cuts in 2025 rose all the way above 30%. What happened to the market? The market pulled back 4%. Then from Jan 10th through the end of last week, thereabouts, that probability of rate cuts in 2025 came back down to, of no cuts in 2025, I should say, pulled back down below 10%. Markets rallied 5%. So I think, markets have been yinning and yanging with that probability of no cuts in 2025. That's something I'm going to watch. Like I said, I think cuts will come. I think markets pricing in maybe the first cut by June. But if this tariff thing continues, right, I don't think it's about inflation and things. I will say focus on what the Fed does in reaction to this tariff uncertainty. That's the key. To your point, if we reach a situation the market's not pricing in any cuts in 2025, I would say that's a problem for risk assets. At this point, I don't expect that, but something to watch.
No, well said there. Well said. I mean, believe me, there. We get paid to worry. We get paid to look at risks, but we also get paid to understand what's going on out there. And the truth is, we still see more opportunities and more strengths than the weaknesses and the threats that are out there. So we've hit about the 45-minute mark. So we definitely want to thank thousands of people who spent the last 45 minutes.
By the way. So.
Yeah. Oh, how was it? Where was it from? Where was it from?
Potbelly. I don't have a grader. Well, no, that's the thing. I actually, for the side story, we have a minute or something, so I'll tell the story. I found out this weekend there's actually a Grader's in Chicago.
Yeah. Well, sorry, what was that?
No, I found out this weekend that there's a Grader's ice cream in Chicago, in Winnetka. I never knew that. And my wife's an Ohio person. She grew up in Columbus, so she was really pumped about that. I got a chocolate milkshake. And yeah, that Grader's in Winnetka is at the exact location. It used to be the store that Kevin in Home Alone went to buy his toothbrush. Right? Now it's a Grader's.
Yeah, you talk about exports. So I live in Cincinnati. Cincinnati is known for many things. One of them being Grader's ice cream. Our exports, I think 92% of all exports to Cincinnati are Grader's ice cream. I made that number up. It's not true, but it's a lot of our exports in this city are Grader's ice cream.
We'll take that.
We are honored. So many people, so many financial advisors out there took the time to hear what our team is up to, how we're seeing the world. I know a lot of our Carson partners joined, so thank you so much for the partnership and the friendship and always being there and helping your clients. And if you're a financial advisor and you're out there and you checked out this video and you enjoy, or this live stream and you enjoyed it, and you're maybe somewhere where you're not all that happy, and you're looking around saying, I'm not getting the support I need. Did your research team do an hour-long Q&A webinar yesterday? Did your research team do a client-approved blog immediately? Did your research team do an hour-long live stream like this? Did your research team answer tons and tons of emails, personal emails, one-on-one emails? If the answer is no, we're just the research bubble of Carson. But there's a lot of stuff like that Carson Group is doing that's moving the needle, that's helping people find their freedom, that's helping advisors grow faster, make more money, end of the day, help them help their clients make more money, and maybe have a little bit of fun along the way. So if that sounds like something you'd like to learn more about, check out carsongroup.com or just reach out to us. But carsongroup.com, we'd love to talk a little bit more. With all that, everybody, things are still looking pretty good out there. If things just spiral out of control, we'll probably do another one of these. So with all that, everyone, enjoy the rest of today's Tuesday, right? Enjoy the rest of your Tuesday. It feels like, who knows what it feels like. It's been a long couple of weeks. But anyway, we appreciate it, and keep listening to Facts versus Feelings. We talk about this stuff all the time on there. Thank you. Take care. Bye-bye.
Bye-bye.